The arithmetic looked harmless enough. A lower coupon, a modest adjustment, a patriotic gesture in difficult times. That was how it was described in the corridors of power, where spreadsheets replaced the quiet rituals of clipping bond coupons. The state had not defaulted. Payments continued. The machinery of finance remained intact. Yet the subtle reduction in yield carried a deeper implication, one that lingered beyond individual bank accounts. For decades, the war loan had been more than a security. It was a symbol of participation in a national struggle that felt morally unambiguous. Families who purchased those bonds during the Great War believed they were lending to victory itself, trading present savings for future stability. The promise of 5% interest was not merely compensation. It was reassurance that sacrifice would be remembered in financial form. By the early 1930s, that memory collided with a harsher reality. The global economy had slowed to a crawl, trade contracted, and unemployment settled into daily conversation. Governments faced a contradiction that had no comfortable resolution. Debt accumulated during wartime now burdened peacetime budgets. Yet the political appetite for overt default remained unthinkable. Confidence in sovereign promises had become a fragile pillar supporting the broader financial system. Inside the Treasury, the war loan loomed like a relic that refused to fade. Its high coupon meant a continuous transfer from taxpayers to bondholders at a time when fiscal capacity was shrinking. The arithmetic was unforgiving. Servicing the debt at its original rate consumed resources needed elsewhere. Yet any attempt to alter the terms risked unsettling the very savers who had trusted the government most. The dilemma was not about solvency alone. It was about hierarchy, who ultimately bore the cost of past commitments. The decision that followed was presented as conversion rather than coercion. Holders were invited to exchange their 5% bonds for new securities paying 3.5%. The language emphasized voluntariness, patriotism, and stability. Newspapers framed it as prudent housekeeping, a rational adaptation to new economic conditions. Behind that framing, however, lay an implicit pressure that few could ignore. Declining participation risked isolation from liquidity as markets began treating the old bonds as obsolete instruments drifting toward illiquidity. Participation surged not because every investor agreed, but because refusal carried invisible penalties. Financial institutions signaled their preferences quietly. Portfolio managers anticipated that the old securities would become difficult to trade, less acceptable as collateral, and increasingly sidelined in institutional portfolios. The conversion thus unfolded as a collective migration, one where individual dissent seemed impractical. The state had not forced compliance through law. It had reshaped the environment so that compliance felt inevitable. The broader context mattered. The early 1930s were marked by deflationary pressure and a persistent fear of financial breakdown. Bank failures elsewhere in the world cast long shadows over domestic confidence. In such an atmosphere, preserving stability often outweighed maximizing yield. Accepting a lower return felt safer than testing the resilience of the system. This psychological backdrop transformed what might have been contentious into something resembling reluctant consensus. Yet beneath the calm surface, the conversion altered the flow of income across society. Rentiers, retirees, and cautious savers who depended on fixed returns experienced a quiet erosion of purchasing power. The reduction was not catastrophic, but its permanence introduced a new vulnerability. Meanwhile, the government achieved immediate fiscal relief, reducing its annual interest burden without triggering the reputational damage associated with default. The adjustment redistributed resources silently, moving them from private balance sheets to public budgets. Banks occupied an intermediate position. On one hand, they supported the conversion as a stabilizing measure that protected the sovereign credit underpinning their own portfolios. On the other, they benefited from a landscape in which lower yields encouraged investors to seek alternative assets, often flowing through the banking system. The conversion thus reinforced institutional insulation. Financial intermediaries adapted quickly, while individual savers absorbed the adjustment more directly. The mechanics of the operation revealed an overlooked aspect of sovereign power. Governments need not repudiate debt outright to redefine creditor relationships. By influencing market conventions, collateral eligibility, and expectations of future liquidity, they can guide investors toward outcomes that serve fiscal priorities. The war loan conversion exemplified this subtle leverage. Formal property rights remained intact, yet the economic substance of those rights shifted. Many participants struggled to articulate what had changed. The bonds were still valid, payments still arrived, and legal ownership remained unchanged. What disappeared was the implicit assumption that contractual terms were immutable. The conversion introduced the notion that sovereign obligations existed within a broader political and monetary framework capable of reinterpretation. Trust did not collapse, but it became conditional, shaped by evolving circumstances rather than fixed promises. For households, the experience unfolded gradually. Budget adjustments replaced expectations of stable income. Conversations about thrift gained urgency. Some investors accepted the change as a patriotic contribution to national recovery, reframing financial loss as civic duty. Others felt a quiet resentment, sensing that loyalty during wartime had translated into diminished security during peace. These emotional responses rarely surfaced in official narratives, yet they defined the lived reality of the conversion. Institutional investors navigated the transition differently. Pension funds and insurance companies recalibrated actuarial assumptions, absorbing lower yields through long-term adjustments rather than immediate hardship. Their scale and diversification provided buffers unavailable to individual savers. This divergence highlighted a structural distinction. Exposure to sovereign decisions varied not only by asset ownership but by the capacity to adapt. Insulation emerged as a function of institutional design rather than foresight. The conversion also intersected with broader monetary developments. Lower interest obligations supported fiscal consolidation, which in turn influenced confidence in the currency and government securities more broadly. The operation demonstrated that debt management could serve as an instrument of macroeconomic stabilization. By reducing the burden of interest payments, the state created space to navigate deflationary pressures without resorting to overt austerity or disruptive defaults. Observers at the time often described the episode as a technical success. Markets remained orderly, the government achieved its objectives, and public discourse avoided the drama associated with financial crises. Yet success carried an undercurrent of ambiguity. The quietness of the operation obscured its redistributive character, leaving many participants aware of loss but uncertain about its origins. The absence of visible conflict did not eliminate the sense that a boundary had been crossed. Looking back, the conversion illustrates a moment when creditor identity subtly transformed. Bondholders, who once perceived themselves as lenders to the state, discovered that their role existed within a hierarchy, shaped by policy priorities. The government, through coordination and expectation management, assumed a more active position in defining the terms of indebtedness. Creditorship became less a static legal status and more a negotiated position within an evolving financial system. The episode also revealed the power of narrative in shaping acceptance, framing the conversion as voluntary and patriotic softened resistance, aligning individual behavior with collective objectives. Language functioned as a financial instrument, guiding perception and facilitating compliance. The effectiveness of this framing depended on trust accumulated over years of stable governance. Without that reservoir of credibility, the same proposal might have provoked resistance rather than cooperation. As the decade progressed, the immediate memory of the conversion faded into the background of economic recovery and geopolitical tension. Yet its legacy persisted in the architecture of sovereign debt management. Governments elsewhere observed that refinancing at lower rates could achieve fiscal relief without overt confrontation. Investors, meanwhile, internalized the possibility that contractual certainty coexisted with political flexibility. The boundary between voluntary adjustment and implicit coercion remained blurred. For those who lived through the experience, the realization arrived slowly. The bonds that once symbolized secure participation in national finance now embodied a lesson about vulnerability to policy shifts. Wealth had not disappeared through collapse or inflation, but through a redefinition of promises. The transformation lacked drama, which made it harder to process yet more enduring in its implications. The quiet corridors where the decision originated eventually returned to routine. Budgets balanced, markets evolved, and new challenges displaced old concerns. Still, the conversion lingered as an example of how financial systems absorb pressure, through subtle adjustments rather than visible rupture. It demonstrated that stability can mask redistribution and continuity can coexist with structural change. Long after the letters were filed away and the new coupons normalized, a faint question remained embedded in collective memory. When governments carry immense debts, the identity of the true creditor may depend less on legal ownership than on the evolving balance between fiscal necessity and political possibility. The war loan conversion did not shatter confidence, but it quietly reframed its foundations, leaving behind a sense that the calmest moments sometimes conceal the most consequential shifts.